There's a question that haunts every person who has ever put a dollar into the market. It's a quiet, creeping dread that begins in the pit of your stomach when a stock you bought with confidence starts to bleed. It's the question that whispers to you when that small 1% dip becomes a 5% drop and then a 10% crater. The question is simple: what do I do now? And for 99% of people, the answer they give themselves, the story they tell to silence the fear, is the single most destructive financial lie in existence. They say, "I'll just wait for it to come back to what I paid for it. I just need to get back to even." This phrase, this seemingly rational and patient sentiment, is a financial siren song, luring countless portfolios onto the rocks of catastrophic loss. It is the anthem of the amateur, the prayer of the hopeful, and the enemy of the wealthy. Because the wealthiest, most successful investor in modern history, Warren Buffett, operates on a principle that is the polar opposite. He has built a $100 billion personal fortune and a $600 billion empire not just on his ability to find winners, but on his almost supernatural ability to deal with his losers. His philosophy isn't about waiting to get back to even. It's about recognizing you're in a hole and adhering to the first rule of holes: stop digging. Instantly. This isn't a simple stock tip. This is a deep dive into the psychology of wealth, a surgical procedure on the part of your brain that confuses ego with financial strategy. We are about to deconstruct the single most profitable habit you can ever develop: the billionaire habit of admitting you're wrong, instantly and decisively. We will explore the precise mental models Buffett uses to execute a losing investment, liberating his capital from financial prisons. We will uncover the powerful cognitive biases that keep the average person shackled to their mistakes, and we will install a new operating system in your mind, one designed for capital preservation and relentless opportunism. This is the final promise you must make to yourself: to never again let your pride cost you your profit. Our journey begins not in the hallowed halls of Wall Street, but in the quiet, unassuming state of Maine, amidst the scent of leather and the hum of old machinery. This is the story of Dexter Shoe Company, a name that for Warren Buffett is not a symbol of triumph, but a constant, nagging reminder of his single greatest investment mistake. And in understanding this colossal error, we uncover the first pillar of our new mental framework, the doctrine of instantaneous reevaluation. To truly grasp the magnitude of the Dexter Shoe story, you must transport yourself back to 1993. The American economy was roaring. The idea of "Made in America" was more than a slogan. It was a promise of quality, a badge of honor. Dexter Shoe was the embodiment of this promise. Founded in a converted old grist mill, it had grown into a formidable manufacturer of sturdy, comfortable, American-made footwear. It was a good business, a solid business run by good, solid people. It had what Buffett loves most: a durable, seemingly impenetrable competitive advantage, or what he calls a moat. People knew Dexter. They trusted Dexter. They would walk into a store, see the name, and feel a sense of security. This was precisely the kind of company Buffett had built his fortune on: unsexy, reliable, and deeply embedded in the American commercial landscape. The owner, Harold Alfond, was a man Buffett deeply admired. He was a straight shooter, a brilliant operator who had built the company from the ground up. So when the opportunity arose for Berkshire Hathaway to acquire Dexter Shoe, it seemed like a perfect fit. The price was $433 million. But Buffett didn't pay with cash. In a move that would prove to be monumental, he paid with Berkshire Hathaway stock. At the time, this seemed like a stroke of genius. He was using his own highly valued paper to buy a solid, cash-generating asset. He wasn't just buying a company, he was validating its place in the Berkshire family, a collection of America's finest businesses. In his letter to shareholders, Buffett praised Dexter to the heavens. He wrote about its strong brand, its excellent management, and its seemingly unbreachable position in the market. The purchase was made, the deal was done, and Dexter Shoe was now a part of the Berkshire Hathaway empire. But then, something began to change. The world, as it often does, refused to stand still. Quietly at first, then with gathering force, the tectonic plates of the global economy were shifting. Low-cost manufacturing from overseas, a trickle in the 1980s, became a flood in the 1990s. Countries with dramatically lower labor costs began to produce shoes that, while perhaps not of the same handcrafted quality as Dexter's, were significantly cheaper. The American consumer, facing their own economic pressures, began to make a different calculation. The brand loyalty, the Made in America premium, started to erode. The moat that Buffett had paid nearly $500 million for was being drained, not by a rival American company, but by a global economic force he had failed to fully appreciate. The numbers coming out of Dexter began to tell a grim story. Sales stagnated, margins compressed, the once mighty profit engine started to sputter. Now, here is the critical moment. This is the moment where 99% of investors, CEOs, and individuals begin the process of denial. They would say, it's just a temporary downturn. The market is just being irrational. Our brand is strong, customers will come back. We just need to invest more in marketing, maybe a new product line. They would start digging the hole deeper, throwing good money after bad, because the alternative, admitting that the initial $433 million decision was a catastrophic error, was psychologically unbearable. But Warren Buffett is not the 99%. He practices the doctrine of instantaneous reevaluation. He did not look at the situation and ask, how can we make this work? He looked at the new evidence, the relentless influx of foreign competition, the changing consumer habits, and asked a much more brutal, much more honest question. Knowing what I know today, would I buy this business? The answer, ringing with painful clarity, was no. The competitive moat was gone. It had not just been narrowed, it had been completely filled in by the sands of globalization. The fundamental reason for buying the business, its durable competitive advantage, had ceased to exist. He didn't sugarcoat it. In his letters to shareholders, a place where most CEOs go to paint rosy pictures, Buffett performed a public autopsy on his own mistake. He wrote, with brutal honesty, that he had been wrong. He had misjudged the durability of Dexter's moat. He didn't blame the economy, or foreign governments, or his managers. He blamed himself. He stated that not only was the initial investment a complete write-off, meaning the entire $433 million in value had evaporated, but it was far, far worse than that. Because he had paid with Berkshire stock, the true cost was not the $433 million from 1993. The true cost was what that stock would be worth today. As of his later writings, that block of stock would have been worth billions, potentially tens of billions, of dollars. He called it his worst deal ever, a mega mistake. He had traded a piece of the world's greatest compounding machine for a melting ice cube. He reevaluated his decision based on the new reality, and he admitted the failure completely and publicly. This act of intellectual honesty is the bedrock of capital preservation. The psychological principle that makes the Dexter shoe story so rare and so powerful is Buffett's ability to override a deeply ingrained human flaw, the commitment and consistency bias. This bias, famously detailed by psychologist Robert Cialdini, is the subconscious human desire to be, and to appear, consistent with what we have already done. Once we have made a choice or taken a stand, we will encounter personal and interpersonal pressures to behave consistently with that commitment. It's a mental shortcut. Instead of reanalyzing a complex situation every time new information arises, our brain simply says, I already made a decision here, and I'm a smart, consistent person, so I'll stick with it. When you buy a stock, you are making a public, even if only to yourself, declaration, I believe this company is a good investment. Your ego is now intertwined with that decision. If the stock goes down, new information is presented that challenges your initial thesis. The commitment and consistency bias kicks in with overwhelming force. To sell the stock for a loss is to admit, on a deeply personal level, I was wrong. My judgment was flawed. I made a mistake. For the human ego, this is an incredibly painful admission. It's far easier, psychologically, to double down. To tell yourself, the market is wrong, I'm right, it will come back. You start looking for evidence that confirms your initial decision, a related cognitive flaw known as confirmation bias. You'll read the one bullish analyst report and ignore the 10 bearish ones. You'll focus on a meaningless piece of good news about a new product, while ignoring the disastrous quarterly earnings report. This isn't just a weakness, it's a cerebral survival mechanism gone haywire in the modern financial world. In our evolutionary past, consistency was a valuable trait. A tribe member who was consistent and predictable was reliable. Changing your mind frequently was seen as erratic and untrustworthy. So our brains evolved to reward consistency with feelings of comfort and integrity, and to punish inconsistency with feelings of cognitive dissonance, that uncomfortable mental stress of holding two conflicting beliefs at once. When you hold a losing stock, the two beliefs are: 1. I am a smart investor who makes good decisions, and 2. This investment is currently a bad one. The easiest way to resolve the dissonance is not to change the first fundamental belief about yourself, but to deny the second. You distort reality to protect your ego. You tell yourself the story that it will come back to, even. Buffett's mind works differently. He has trained himself to disconnect his ego from the investment decision. He understands that the market does not know or care what he paid for a stock. The current price is simply the current price. His decision to own it must be based solely on its future prospects, not its past performance in his portfolio. His admission of the Dexter shoe mistake was a massive, public display of overriding this bias. He was saying, my past commitment to this idea is irrelevant. The new data shows the idea is flawed. Therefore, the commitment is void. This mental decoupling of ego from outcome is not natural. It is a trained, disciplined skill, and it is the first and most critical step in professional risk management. So how can we as individuals apply this powerful doctrine? We need a practical tool, a mental model that forces this same intellectual honesty. The blueprint for this is something we can call the zero-basis repurchase test. It is a simple but profoundly effective thought experiment that you should conduct on your portfolio at least once every quarter. The process is granular and must be followed with discipline. Step 1. Imagine that you have sold every single holding in your portfolio. Your account is now 100% cash. Feel the relief. The emotional weight of your losers is gone. The attachment to your winners is gone. You are starting fresh, from zero. This act of mental liquidation is crucial because it severs the tie to your past decisions and the prices you paid. Step 2. Now look at the list of stocks you just notionally sold. Go down them one by one. Let's take that one stock that is down 20%, the one that keeps you up at night. Let's call it Struggling Corp. Step 3. Ask yourself this one, brutally honest question. Knowing everything I know today about the company, its industry, the economy, and its current stock price, would I take my fresh, clean cash and buy this stock right now, today? Be ruthless in your answer. This is not about whether you think it will come back. It is not about your hope of breaking even. It is a simple binary decision. Is this specific company, at this specific price, the absolute best place you could possibly put your capital right now, out of all the thousands of options available in the market? Step 4. If the answer is a resounding yes, I'd buy even more at this price, then you have a genuine, conviction-based reason to continue holding. But if the answer is anything less than that, if it's a maybe, a I'm not sure, or, most tellingly, an honest, no, I wouldn't buy it today, but I'm just holding it until it gets back to my price, then you have your answer. You must sell it, immediately. The logic is inescapable. If you wouldn't buy it today, then continuing to hold it is functionally the same as buying it today. You are making an active decision to allocate that portion of your capital to that stock every single day you choose not to sell it. The zero-basis repurchase test strips away the emotion, the anchoring to your original purchase price, and the ego-driven need to be right. It forces you to re-justify the investment from scratch, based on the present reality, not the past hope. Scheduling this quarterly review in your calendar and physically writing down your yes or no for each holding turns a vague emotional process into a disciplined, professional portfolio management strategy. It's the first line of defense in building genuine wealth protection. To truly appreciate the power of this model, we must examine its opposite, the antithesis, the path of the 99%. This is the well-trodden road of the hope and pray strategy, also known as getting back to even. Let's paint a picture of this all-too-common tragedy. Imagine an investor, we'll call him Bob. Bob hears about a hot technology company, Future Tech, on a financial news show. The story is compelling. Disruptive technology, visionary CEO, a total addressable market in the trillions. Bob gets excited. He does some cursory research, which mostly consists of reading other bullish articles that confirm his excitement. He buys Future Tech at $100 per share. For a few weeks, everything is great. The stock goes to $110. Bob feels like a genius. He casually mentions his brilliant pick to his friends. His ego is now fused to Future Tech. Then, the market turns. A competitor announces a breakthrough. Future Tech's growth slows slightly. The stock drops to $80. Bob isn't worried. It's a buying opportunity, he tells himself, though he doesn't actually buy more. He's anchored to his $100 purchase price. His goal is no longer about the fundamental prospects of the business. His goal is now to see the number 100 again on his screen. Then, a bad earnings report comes out. The stock gaps down to $50. Now panic mixes with stubbornness. The pain of selling and realizing a 50% loss is too much to bear. It would mean admitting he was a fool. So he constructs a new narrative. The market is overreacting. The long-term story is still intact. He stops checking the stock price every day because it's too painful. He's no longer an investor. He's a hostage. The stock drifts lower over the next year to $20. His initial investment is now down 80%. He might sell then, out of sheer exhaustion and disgust, locking in a catastrophic loss. Or, worse, he might just leave it in his account forever, a digital tombstone reminding him of his failure, tying up precious capital that could have been working for him elsewhere. Bob's journey is the path of the 99%. He did not reevaluate the thesis when new data emerged. He clung to his initial decision, his ego demanding vindication. He anchored to his purchase price as if it had some cosmic significance. And he allowed a manageable mistake to metastasize into a portfolio-crippling disaster. He was digging, and instead of stopping, he just kept digging, hoping to find his way back to the surface. That is the antithesis of the Buffett approach. It is the emotional, ego-driven path that ensures mediocrity in the world of investing. The financial connection here is stark and quantifiable. The cost of refusing to reevaluate is not just the loss incurred, it is the staggering opportunity cost of trapping your capital in a failing enterprise. This trapped capital is what investors call dead money. It's not working for you, it's not compounding, it's just sitting there, decaying. Let's run the numbers. Imagine you have $10,000 invested in Bob's Future Tech. You bought it at $100, and it's now at $80, a $2,000 loss. You decide to hold on, waiting to get back to even. Over the next 5 years, the company stagnates. Your $8,000 of remaining capital just sits there, eventually drifting down to $7,000. Your total loss is $3,000. Now consider the alternative, the Buffett approach. You bought at $100, it drops to $80. New information has come to light that invalidates your original thesis. You run the zero-basis repurchase test. The answer is no. You sell. You take the $2,000 loss. It stings, but you now have $8,000 in cash. You've liberated your capital. You take that $8,000 and after careful research, you invested in a solid blue-chip company that grows at a conservative 10% per year. In 5 years, That $8,000 compounding away will have grown to over $12,800. In the first scenario, your initial $10,000 became $7,000. In the second scenario, your initial $10,000 became $12,800. The difference is nearly $6,000. That is the price of your ego. That is the cost of refusing to admit you were wrong. The doctrine of instantaneous reevaluation isn't just a philosophical stance, it's a mathematical imperative. It's the mechanism that transforms your portfolio from a museum of past mistakes into a dynamic, forward-looking engine for wealth creation. Admitting the mistake, as with Dexter's shoe, isn't the end of the story. It is the necessary first step to freeing your resources for the next, better opportunity. It is the foundation of all serious financial discipline. Recognizing the mistake is the first crucial hurdle. But what comes next is an act of will, a deliberate and often painful action that separates the professional from the amateur. This brings us to our second pillar, the art of capital liberation. This is the mechanics of pulling the trigger, the disciplined process of selling a losing position to free up your money for a more productive use. It is one thing to know you should sell. It is another thing entirely to bring yourself to do it. For our foundational anecdote, we turn to a much more recent and public example of Buffett's philosophy in action. The year is 2020. The world is grappling with the sudden, terrifying onset of the COVID-19 pandemic. Global travel has ground to a halt. Planes are parked on runways, airports are ghost towns, and the entire airline industry is facing an existential crisis. Just a few years prior, Warren Buffett, who had famously sworn off investing in airlines for decades, calling them a death trap for investors, had changed his mind. Starting in 2016, Berkshire Hathaway had built up massive positions in the four largest U.S. carriers: American, Delta, Southwest, and United. By early 2020, these stakes were worth well over $4 billion. Buffett had seemingly been won over by industry consolidation, better capital discipline, and steadily rising profits. His thesis was that the industry had fundamentally changed for the better. Then, the pandemic hit, and the world changed overnight. The fundamental assumption behind his investment, that people would continue to fly in ever-increasing numbers, was not just challenged, it was obliterated. The very viability of these businesses was now in question. They were burning through billions of dollars in cash just to stay afloat, with no clear timeline for a return to normalcy. Once again, we arrive at a critical juncture. What would the average investor do? They would look at their massive losses on paper. They would think about the price they paid. They would tell themselves, this is a once-in-a-century event. Travel will come back eventually. These are the biggest airlines. They won't be allowed to fail. I'll just hold on. They would be paralyzed by the magnitude of the loss and the hope of a rebound. But Warren Buffett, at the virtual Berkshire Hathaway annual meeting in May 2020, did something extraordinary. He didn't just trim his positions. He didn't just express concern. He stood before the world and announced that Berkshire had sold its entire stake in all four airlines. All of it. He had liquidated the entire multi-billion-dollar position, booking a significant loss. He didn't wait for a government bailout to prop up the stocks. He didn't wait for the inevitable recovery. He acted, decisively and completely. His explanation was a masterclass in the art of capital liberation. He stated, simply and without ego, the world has changed for the airlines. He admitted that he didn't know how the future of air travel would unfold, but he knew with certainty that the range of outcomes had shifted dramatically for the worse. The business he had invested in was no longer the same business. His thesis was broken, and when the thesis is broken, the position must be sold. He took the loss, accepted the pain, and liberated billions of dollars of Berkshire's capital from an industry whose future had become terrifyingly uncertain. He didn't know what he would do with the money next, but he knew with absolute certainty that holding it in the airlines was the wrong move. This was not a panic sale. It was a cold, logical, and disciplined execution based on a reevaluation of the facts. It was the art of freeing your soldiers from a battle that can no longer be won. so they can live to fight another day on more favorable ground. The psychological demon that Buffett slayed in that moment is one of the most powerful and well-documented biases in behavioral finance: loss aversion. First identified by Nobel laureates Daniel Kahneman and Amos Tversky, loss aversion is the principle that for most humans, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels twice as bad as finding $100 feels good. This asymmetry has profound implications for investors. As long as you are holding a stock that is down, the loss is a paper loss. It's theoretical, it exists on your screen, but it hasn't been finalized. In the back of your mind, hope still exists. The hope that it will recover, that the pain can be avoided. The act of selling, however, changes everything. The moment you hit that sell button, the loss becomes real. It is crystallized. It moves from a theoretical number on a screen to an actual permanent reduction in your account value. The pain becomes acute. Your brain is hardwired to avoid this pain. The amygdala, the primitive part of our brain responsible for the fight-or-flight response, lights up when we contemplate realizing a loss. It treats the financial loss as a genuine threat to our survival. Therefore, the path of least psychological resistance is to do nothing, to hold on, to avoid the sharp, certain pain of selling today in favor of the vague, uncertain hope of a better tomorrow. This is why so many people ride their losing stocks all the way down to zero. At each step of the decline, the pain of selling and making the loss real seems greater than the pain of just holding on for one more day. Buffett's decision to sell the airlines was a direct defiance of loss aversion. He accepted the certain, immediate, and public pain of a multi-billion-dollar loss in order to avoid the potential for an even greater, more protracted loss in the future. He focused not on the pain of the past mistake, but on the logical imperative of future capital preservation. This requires immense emotional investing discipline. It means training your rational prefrontal cortex to override the screaming alarms of your primitive amygdala. It's a skill, and like any skill, it can be learned and strengthened through practice and the use of proper mental models. To systematically practice this art, you need a blueprint that forces you to confront potential failure before you even begin. The most effective mental model for this is the pre-mortem, a concept developed by psychologist Gary Klein. Unlike a post-mortem, which analyzes a failure after it has happened, a pre-mortem is an exercise in prospective hindsight. You conduct it before you ever invest a single dollar. Here is the step-by-step process for applying the pre-mortem to your investment decisions. Step 1. Before you buy a new stock, gather your thesis. Write down exactly why you believe this is a good investment. Be specific. Step 2. Now imagine it is 1 year in the future. You have made the investment, and it has been an unmitigated disaster. The stock is down 50%. It was a terrible decision. Step 3. In this imagined future, your task is to write the story of why it failed. What went wrong? Spend at least 10 to 15 minutes brainstorming every possible reason for the failure. Did a key competitor emerge? Did the company's technology become obsolete? Was there a management scandal? Did a change in regulations destroy their profit margins? Did a global pandemic change their entire industry? Be creative and comprehensive. Step 4. From this list of potential failure points, identify the top 3 to 5 most plausible and critical risks. These are your thesis breakers. These are the specific events or conditions that would fundamentally invalidate your reason for owning the stock. For example, if you're investing in a pharmaceutical company because of a promising new drug, a thesis breaker would be the FDA's failure to approve that drug. Step 5. Write these thesis breakers down and keep them with your original investment thesis. These are now your predefined exit conditions. They become your tripwires. If one of these events occurs, the decision to sell is no longer an emotional one. It becomes a simple, mechanical execution of a predetermined plan. You've already done the hard thinking while you were calm and rational. You're not debating whether to sell in the heat of a market panic. You're simply following the instructions you gave your future self. The premortem is the ultimate tool for risk management because it changes the question from, should I sell now that I'm losing money, to, has one of my predefined kill switches been tripped? This systematic approach is the hallmark of professional trading discipline and a powerful antidote to loss aversion. The antithesis to this discipline process is a mental trap we can call the anchor. This is the tendency to become mentally fixated on an initial piece of information, usually the price at which you bought a stock. This purchase price becomes an anchor that drags down all your future decision-making. Let's go back to our investor Bob with Future Tech. He bought it at $100. When the stock is at $80, he doesn't evaluate the company based on its current market capitalization, its earnings power, or its competitive position. He evaluates it relative to his anchor. $80 is cheap, he thinks, compared to the $100 I paid. When it drops to $50, his anchor makes it seem like an incredible bargain, even if the fundamental reality of the business has deteriorated so badly that it's actually overvalued at $50. This anchor prevents any rational analysis. The market doesn't care that Bob paid $100. A new investor looking at the stock for the first time is evaluating it at its current price of $50, with a fresh set of eyes. But Bob can't do that. He is mentally shackled to a number that has no bearing on the company's future value. This anchor is what fuels the get back to even mentality. The goal shifts from making a sound investment to simply erasing a psychological wound. People who fall prey to the anchor stop being active participants in their financial future. They become passive victims, hoping the tide of the market will eventually lift their sunken ship back to the surface. It's a complete abdication of portfolio management, driven by a simple, powerful, and destructive cognitive bias. The direct financial connection of mastering the art of capital liberation is profound and rooted in the unforgiving mathematics of compounding. While we all love to talk about the magic of positive compounding, its evil twin, negative compounding, is far more destructive. The numbers are brutal. If you lose 10% on an investment, you need an 11% gain to get back to even. Manageable. If you lose 25%, you need a 33% gain to recover. Getting harder. But if you lose 50%, as so many do by holding on to their losers, you now need a 100% gain just to break even. A 100% gain. Finding an investment that can double in value is incredibly difficult. By allowing a small loss to turn into a huge one, you have put yourself in a position where you need to be a heroic investor just to get back to where you started. Let's put this in the context of Buffett's airline sale. By selling and realizing, say, a 25% loss, he needed to find an investment that could generate a 33% return to make that capital whole. Difficult but possible for an investor of his caliber. Had he held on and had the airlines dropped 75%, a very real possibility at the time, he would have needed a 300% gain to recover. The math becomes exponentially more punishing the deeper you let your losses run. This is why Buffett's first rule of investing is never lose money, and the second rule is never forget rule number 1. He doesn't mean never take a loss on a single stock. That's impossible. He means do not suffer a permanent catastrophic impairment of capital. The art of capital liberation, of cutting losses decisively, is the practical application of that rule. It is a core tenet of wealth protection. It ensures that your mistakes are small and manageable, while your winners are allowed to run. By mechanically cutting off the left tail of your return distribution, the part with the catastrophic losses, you dramatically improve the long-term compounding rate of your entire portfolio. It is the single most powerful defensive maneuver in any investor's playbook. We've established the need to recognize a mistake and the discipline to act on it. But to make this behavior permanent, we must go deeper. We need to wage war on the internal enemies that make this so difficult in the first place. This brings us to our third and perhaps most crucial pillar: de-weaponizing your own mind. This is the process of understanding and neutralizing the specific cognitive biases that are genetically programmed to make you a bad investor. This is where we fight the battle not in the market, but in the 6 inches between our ears. Our guiding anecdote here is not a story of Buffett cutting a loss, but a story of how he was saved from making one by having his own deeply ingrained mental model challenged and defeated. It's the story of See's Candies and the man who de-weaponized Buffett's own mind, Charlie Munger. For the early part of his career, Buffett was a pure value investor, in the mold of his mentor Benjamin Graham. He looked for cigar-butt businesses, companies that were beaten down and trading for less than their liquidation value. They might be terrible businesses, but they were so cheap that you could get one last puff of profit out of them before they died. This was his formula, his system. It worked, and it had made him a very rich man. His entire mental framework was built around buying things on the cheap. In 1972, Buffett and Munger were presented with an opportunity to buy See's Candies, a beloved West Coast manufacturer of premium chocolates. The company had a fantastic brand, incredible customer loyalty, and a decent record of profitability. The problem was the price. The sellers wanted $25 million. By Buffett's cigar butt metrics, this was outrageous. The company's tangible assets, its factories, its inventory, were only worth about $8 million. The sellers were asking for a massive premium for intangible things like brand and goodwill. Buffett's deeply ingrained mental habit screamed, "No!" It was too expensive. He was on the verge of walking away. This is where Charlie Munger stepped in. Munger had a different perspective. He argued that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. He understood that the true value of See's wasn't in its physical assets, but in its powerful brand. Its moat. This brand allowed See's to raise its prices year after year without losing customers. It was a compounding machine of a different kind. Munger relentlessly argued with Buffett, challenging his core investment philosophy. He was essentially telling Buffett, "Your old way of thinking, the one that made you successful, is wrong for this situation. You have to admit that your model is flawed and adapt." Eventually, Buffett relented. He overcame his own internal bias for cheapness and agreed to pay the $25 million. It was a pivotal moment in his career. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, requiring very little additional capital investment. It completely changed Buffett's approach to investing. It taught him the value of paying up for quality. The See's Candies deal wasn't about selling a losing stock. It was about selling a losing mental model. Buffett had to admit that his deeply held cigar butt philosophy was a mistake in the context of great businesses. He de-weaponized his own bias for cheapness, and it opened the door to his later, legendary investments in companies like Coca-Cola and American Express. It was an act of supreme intellectual humility. The psychological principle at the heart of this struggle is the most famous of them all, the sunk cost fallacy. This is the bias that causes us to continue a behavior or endeavor as a result of previously invested resources, whether that's time, money, or effort. The phrase, "throwing good money after bad," is the perfect encapsulation of this fallacy. We see it everywhere in life. You sit through a terrible movie because you already paid for the ticket. You continue pouring money into a failing business project because you've already invested 6 months of work into it. You force yourself to finish a giant meal you're not enjoying because you don't want to waste the money you spent on it. In all these cases, the past investment is sunk. It is gone. It cannot be recovered. Any rational decision should be based only on the future costs and benefits. Will sitting through the rest of this awful movie bring me more pleasure than the pain of staying? Will investing another $10,000 into this failing project generate a positive future return? The past costs are irrelevant, yet our brains are wired to fixate on them. In investing, the purchase price of a stock is the ultimate sunk cost. The money is spent. It is gone. The only thing that matters is the future prospect of the business. But the sunk cost fallacy screams at you. You can't sell now. You've already lost so much. If you just hold on a little longer, maybe you can get that initial investment back. It creates an irrational desire to justify the original decision, to make the sunk cost worth it. This is compounded by another powerful bias, the endowment effect, which states that we place a higher value on things simply because we own them. That losing stock in your portfolio feels more valuable to you than it would to an outside observer, simply because it's asterisk yours. Together, the sunk cost fallacy and the endowment effect create a powerful psychological cocktail that makes it nearly impossible for the untrained mind to make a rational decision about a losing position. To fight this, we need a mental model designed to create deliberate, objective distance. The blueprint for this is the outsider's perspective. This is a role-playing exercise designed to systematically strip out your personal history and emotional attachment to an investment. Here is the process. Step 1. Print out a list of your current portfolio holdings. For each position, write a single sentence summarizing your original reason for buying it. Step 2. Now you're going to fire yourself as the manager of your portfolio. Instead, you have just hired a new, brilliant, and utterly ruthless portfolio manager to take over. Let's call her Amanda. Amanda has a stellar track record. Her only goal is to maximize the portfolio's future returns, and her bonus depends entirely on it. She has no emotional attachment to your past decisions. She feels no pain about the losses you've incurred because they weren't her losses. She has zero sunk costs. Step 3. Now you must become Amanda. Look at the portfolio through her eyes. Go down the list, one stock at a time. For each stock, especially the losers, Amanda would ask a series of cold, hard questions. Based on today's reality, does this business have a durable competitive advantage? Is it generating strong free cash flow? Is its management team executing effectively? Are its future prospects better than the average business in the market? Step 4. Ask yourself, honestly, which positions would Amanda liquidate on her very first day on the job? Which holdings would she look at and say, "This is dead money"? Its thesis is broken. We are selling this immediately to fund better opportunities. Don't just think about it. Take a red pen and physically circle the stocks that Amanda would cut without a second thought. This exercise works because it forces you to adopt a third-person perspective, which is naturally more objective and rational. It leverages a psychological trick called self-distancing. By creating the character of Amanda, you are tricking your brain into analyzing the problem as if it were someone else's, freeing you from the grip of your own sunk costs and endowment effect. It is a powerful way to de-weaponize your own mind and see your portfolio for what it truly is, a collection of business assets that must continuously justify their place. This is how a professional in private equity would look at a portfolio of companies, and it's how you must learn to look at your own. The antithesis of this rational, detached approach is what we can call ego-based investing. This is the path of the investor whose self-worth is inextricably linked to the performance of their stock picks. For this person, an investment is not just a claim on a company's future earnings. It is a public testament to their intelligence and foresight. This investor cannot sell a loser because it feels like a personal failure. They've told their friends and family about their great stock idea. To sell it at a loss would be a public admission of error, a source of shame and embarrassment. Their internal monologue isn't about capital allocation or risk management. It's about social standing. What will people think if I admit I lost money on this? I can't sell it now. My brother-in-law will never let me hear the end of it. This ego-based investor will hold on to a declining stock not because of a rational belief in its future, but because of a desperate need to be proven right. They will ride it down, all the while defending their decision with increasingly convoluted logic. Their identity as a smart investor is on the line, and they would rather suffer a massive financial loss than a small blow to their ego. This is the most dangerous mindset in finance. The market is an impersonal, relentless machine that has no regard for your feelings or your ego. To tie your self-worth to the random fluctuations of the market is to set yourself up for both financial and emotional ruin. It is the complete opposite of the Buffett and Munger approach, where ideas are held provisionally and discarded without sentiment the moment they are proven wrong. The financial connection to this principle is visible on the financial statements of every major corporation in the world. A company's balance sheet is a reflection of its capital allocation decisions. A well-managed company constantly practices the art of de-weaponizing its mind. If a company invests millions in a new product line and it fails to gain traction, a good CEO will shut it down, take the write-off, and reallocate the remaining capital and talent to a more promising division. This is a corporate cutting of losses. A poorly managed company, on the other hand, will fall for the sunk cost fallacy. The executives whose egos are tied to the project will keep throwing good money after bad. We've already spent so much, we can't give up now. This leads to what you see on the balance sheet as impaired assets or goodwill write-downs, accounting terms for admitting that a past investment is no longer worth what you paid for it. Companies that are good at cutting their losses and reallocating capital have high returns on equity. Companies that cling to their mistakes see their returns dwindle and their balance sheets decay. Your personal investment portfolio is your own personal company, Me Inc. Your capital is your asset base. The principles are identical. By refusing to sell a loser because of sunk costs or ego, you are creating an impaired asset on your personal balance sheet. You are lowering your personal return on equity. By mastering the ability to de-weaponize your own mind and make rational, forward-looking decisions, you are adopting the mindset of a world-class CEO, managing your own capital with the same discipline and objectivity required to run a Fortune 500 company. We have now learned to identify a mistake, act on it, and conquer the internal demons that make it so hard. But cutting a loss is a defensive maneuver. It stops the bleeding. The true path to wealth creation involves turning that defense into a powerful offense. This leads us to our fourth pillar, the Phoenix Principle, rising from the ashes of a bad decision. This is the art of not just cutting your losses, but of effectively and intelligently redeploying that liberated capital into superior opportunities, transforming a past failure into the foundation for a future victory. For our guiding story, we look to one of the most dramatic episodes in Buffett's career, his tumultuous investment in Salomon Brothers in the late 1980s and early 1990s. In 1987, Buffett invested $700 million in the high-flying Wall Street investment bank. His thesis was based on the firm's dominant position in the bond trading market and his trust in its charismatic CEO, John Gutfreund. For a few years, the investment performed well. Then, in 1991, a massive scandal erupted. A rogue trader at Salomon had been submitting false bids in U.S. Treasury auctions, a serious violation of federal law. The scandal threatened to bring down the entire firm. Regulators were circling, clients were fleeing, and the company's very survival was at stake. Buffett's $700 million investment was on the brink of becoming worthless. His initial thesis, that this was a stable, well-managed firm, was utterly shattered. Here, the simple act of selling was not a viable option. The market was in a panic, and trying to unload such a huge stake would have been nearly impossible without crashing the price to zero. This was a mistake of a different magnitude. The 99% response would be to despair, to lawyer up, and to brace for a total loss. But Buffett activated the Phoenix Principle. He saw the ashes of his initial investment and resolved to build something new from them. Instead of just cutting his losses, he took an extraordinary step. He stepped in and took control. He flew to New York, forced the resignation of the CEO, and had himself appointed as the interim chairman of Salomon Brothers. A folksy investor from Omaha was now running one of the most aggressive firms on Wall Street in the midst of its biggest crisis. He spent months living in New York, dealing with regulators, calming panicked employees, and testifying before Congress. His famous line from that testimony, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless," set a new tone. He surgically cut out the corrupt elements, stabilized the business, and restored its reputation. After a grueling period, he managed to save the company. He not only prevented his initial investment from going to zero, but eventually shepherded the firm to a successful sale to Travelers Group years later, ultimately turning a handsome profit. This story is the Phoenix Principle in its most extreme form. Buffett recognized his initial thesis was a catastrophic mistake, But instead of just accepting the loss, he took the capital, in this case, his influence, his reputation, and his control over the firm, and redeployed it in a radical new way. He transformed a passive investment failure into an active management success. It demonstrates that rising from the ashes isn't just about finding a new stock to buy. It's about seeing a bad situation not just as a problem to be escaped, but as a new set of resources to be redeployed with creativity and conviction. The psychological barrier that prevents most people from executing the Phoenix Principle is a subtle but powerful one: regret aversion. This is the human tendency to avoid making a decision because we fear that the decision will turn out to be wrong in hindsight. When it comes to selling a losing stock, regret aversion whispers a terrifying question in your ear: what if I sell it today, and tomorrow it doubles? The anticipated pain of that specific form of regret, selling at the absolute bottom, is so intense that it can be paralyzing. This fear of missing out on a potential rebound is often stronger than the fear of the stock dropping further. Why? Because a further drop is just a continuation of the pain you're already feeling. Selling at the bottom, however, would be a new, acute, and self-inflicted wound. It would feel like the ultimate failure of timing and judgment. To avoid this potential regret, many investors choose the perceived safety of inaction. They would rather ride a stock down another 20% than risk the 1% chance that they sell it right before it takes off. This paralysis ensures that capital remains trapped in underperforming assets, because the fear of a bad new decision is greater than the dull, chronic pain of a bad old decision. Overcoming regret aversion is the key to unlocking the Phoenix Principle. It requires shifting your focus from the fear of making a wrong move to the certainty of the opportunity cost you are paying every day you fail to act. The practical blueprint for implementing the Phoenix Principle is a mental model we can call the opportunity cost audit. This model brilliantly reframes the decision-making process, shifting the focus away from the pain of the past and onto the promise of the future. It directly combats regret aversion. Here is the step-by-step process. Step 1. Identify your single worst-performing investment, not just in terms of numbers, but the one whose fundamental thesis is most clearly broken. Let's say you have $5,000 of capital trapped in this position. Step 2. Now put that stock aside. For the next hour, your only job is to do the opposite of what most investors do. Do not research your losers. Instead, research potential winners. Your task is to find what you believe is the single best investment opportunity available in the market right now. A wonderful company at a fair price that you are genuinely excited about for the next 5 to 10 years. Step 3. Do a deep dive into this new company. Understand its business model, its competitive advantages, its management team, and its valuation. Build a case for why this is an exceptional place to put your money. Step 4. Now, and only now, you reframe the decision. The question is no longer, should I sell my loser and take the loss? The new question is, am I willing to pay a $5,000 opportunity cost, the money currently in my losing stock, to not own this incredible new company I've just found? You are forcing a direct comparison. You are making the opportunity cost tangible. The decision is no longer about selling a loser. It's about buying a winner. The capital in the losing stock is the currency you will use to make the purchase. This reframing is a powerful psychological judo move. It channels the brain's natural desire for gains and opportunism to overcome its fear of loss and regret. By focusing on the compelling future of the new investment, the emotional baggage of the old one fades into the background. The opportunity cost audit turns a moment of painful retreat into a moment of exciting advance. It is the engine that allows you to rise from the ashes of one bad decision by using its raw materials to fuel a new, better one. It's the very essence of effective capital allocation. The antithesis to this forward-looking opportunism is a destructive emotional pattern known as the revenge trade. This is what happens when an investor finally summons the courage to take a loss, but does so with a heart full of anger and frustration. They feel stupid, they feel cheated by the market, and their primary emotional driver is a desperate need to make the money back as quickly as possible. This investor, having just liberated their capital, doesn't perform a calm, rational opportunity cost audit. Instead, they immediately take that cash and plunge it into a highly speculative, high-risk bet. They might buy a volatile penny stock, a risky cryptocurrency, or a far out-of-the-money options contract. Their goal is not long-term capital appreciation. It's a short-term dopamine hit, a quick win to erase the sting of the prior loss. This is the financial equivalent of a gambler on a losing streak doubling their bets. The revenge trade is almost always disastrous. It compounds the initial mistake. Because the decision is driven by emotion rather than logic, it often leads to a second, more rapid and even more painful loss. The investor has failed to learn the core lesson of the first mistake, which was about the importance of capital preservation and risk management. Instead, they've only learned to hate losing, and they let that hatred drive them into an even worse decision. It is the phoenix that fails to rise and is instead consumed by the fire. It's a complete failure of the investor mindset, replacing discipline with desperation. The direct financial connection of the Phoenix principle is about increasing the velocity and return on equity of your portfolio. Think of your portfolio's capital like the inventory in a store. A successful retailer wants to turn over their inventory as quickly as possible, selling the goods and reinvesting the cash in new products that will sell. Inventory that sits on the shelf for years is a drag on the business. Similarly, your portfolio has a, quote, velocity of capital. Capital that is stuck in losing, stagnant stocks has zero velocity. It is dead inventory. By systematically cutting these losers and redeploying the capital into more promising businesses, you are increasing the velocity of your capital. You are making your money work harder and more efficiently. This directly impacts your portfolio's overall return on equity, ROE. A portfolio's ROE is the total return it generates divided by its capital base. Every dollar you have tied up in a company with a 2% growth rate is a dollar that isn't in a company with a 15% growth rate. By selling the 2% grower or even a negative grower and buying the 15% grower, you mechanically increase the weighted average growth rate and thus the long-term ROE of your entire portfolio. Let's look at two hypothetical portfolios. Portfolio A holds on to its losers, hoping they'll come back. Its capital is fragmented across a few winners and many stagnant dead money positions. Its overall annual return is a mediocre 4%. Portfolio B is managed with the Phoenix principle. Its manager ruthlessly cuts losers and redeploys the capital into their best ideas. The manager might only be right 60% of the time, but the capital is always concentrated in dynamic, growing businesses. Its overall annual return is 12%. Over 30 years, a $100,000 investment in Portfolio A grows to about $324,000. In Portfolio B, it grows to nearly $3 million. That is the 9-figure difference that comes from not just cutting losses, but from treating every dollar of liberated capital as a precious resource to be immediately redeployed toward its highest and best use. We have now journeyed through the entire life cycle of a mistake, from recognition to action, from internal psychology to external redeployment. But to truly make this a permanent part of your financial DNA, we need one final element, a system. A process that removes the need for heroic, moment-to-moment emotional courage and replaces it with a disciplined, repeatable framework. This is our fifth and final pillar, constructing the unbreakable portfolio. This is about building a personal investment philosophy and set of rules that makes the cutting of losses a default automatic behavior rather than a gut-wrenching decision. The ultimate anecdote for this is not a single transaction but the very creation of Berkshire Hathaway itself. What most people don't realize is that Berkshire Hathaway began its life as a failing New England textile mill. In the 1960s, Buffett took control of the company. It was a classic cigar-butt investment. The business was terrible. The American textile industry was in a terminal decline due to foreign competition, the same force that would later destroy Dexter's shoe. The mills were old, the machinery was inefficient, and the future was bleak. Buffett found himself in a massive sunk cost trap. He had invested a significant portion of his partnership's capital into this dying business. The temptation, the ego-driven path, would have been to try and save it. To invest millions more in new looms, to fight the unions, to believe that his genius could turn around an industry whose economics were fundamentally broken. He could have spent decades throwing good money after bad, trying to vindicate his initial decision. But he didn't. He applied a systematic, unsentimental logic. He recognized that the textile business itself was a colossal mistake. So instead of digging the hole deeper, he began a process of controlled liquidation. He didn't pour the company's meager profits back into the failing textile operations. Instead, he started a radical program of capital redeployment. He took the cash flow that the dying mill was generating and started using it to buy other, better businesses. He bought insurance companies, like National Indemnity. He bought See's Candies. He bought newspapers and banks. Essentially, he treated the original Berkshire Hathaway textile business as a loser to be systematically sold off. He liberated the capital from its unproductive core and redeployed it into a diversified portfolio of wonderful businesses. Over time, the textile operations shrank and were eventually shut down completely. The company that remained was a holding company, a shell that now contained a collection of the world's greatest assets. Berkshire Hathaway, the global behemoth we know today, is the ultimate testament to the Phoenix Principle executed on a grand, systematic scale. It was built by admitting the original business was a mistake and having the discipline to systematically move every dollar of capital away from that mistake and toward better opportunities. It is the greatest trade in financial history, trading a failing mill for a compounding empire. The psychological principle that underpins a systematic approach is the need to overcome hindsight bias and outcome bias. Hindsight bias is the "I knew it all along" phenomenon. After an event occurs, we tend to believe we could have predicted it. If you sell a stock and it then goes up, hindsight bias will torture you, making you believe your decision to sell was obviously stupid. If you hold a stock and it goes to zero, hindsight bias will tell you the outcome was inevitable. This bias makes it impossible to learn from your mistakes because it distorts your memory of what you actually knew at the time. Outcome bias is closely related. We tend to judge the quality of a decision based on its outcome, rather than the quality of the decision-making process at the time. A good process can lead to a bad outcome. Bad luck. A bad process can lead to a good outcome. Dumb luck. For example, if you buy a lottery ticket, a terrible process, and win, a great outcome, you might incorrectly conclude that buying lottery tickets is a good financial strategy. In investing, if you hold on to a terrible speculative stock, bad process, and it gets bought out in a surprise merger, good outcome, you might wrongly believe that your hope and pray strategy works. To build an unbreakable system, you must stop judging your decisions based on their outcomes. Instead, you must focus exclusively on the quality and discipline of your process. A single loss does not mean you have a bad process, and a single win does not mean you have a good one. The goal is to build a robust process that, when followed consistently over hundreds of decisions, will produce superior results over the long term, regardless of the random outcomes of any single event. This shift in focus, from outcome to process, is the final step in becoming a truly professional investor. It removes the emotional sting from individual losses and turns them into what they should be: simple data points in a long-term strategy. The blueprint for creating this system is the Investment Journal and Decision Checklist. This is not a suggestion. It is a requirement for any serious investor. It is the tool that forces a process-oriented approach and serves as your defense against emotional decision-making and cognitive biases. Here's how to construct it. Get a physical notebook or create a digital document. For every single stock you purchase, you will create a new entry. Step 1. Before you buy, you must write down the date, the price, the number of shares, and most importantly, your thesis in 5 bullets. You must concisely state the 5 core reasons why you are buying this business. Is it the dominant market share? The brilliant CEO? The new product cycle? Be specific. Step 2. This is the critical part. You must also write down my thesis is wrong if, and then list 3 to 5 specific, observable thesis breakers. These are the tripwires you developed using the pre-mortem technique. For example, my thesis is wrong if the company loses its contract with its largest customer. Or, my thesis is wrong if their new drug fails its phase 3 trial. Or, my thesis is wrong if their gross margins decline for 3 consecutive quarters. These must be concrete, not vague. Step 3. You have now created a contract with your future self. This document is your operating manual for this investment. You must review your investment journal at least once a quarter. You read your original thesis and then you check to see if any of your predefined thesis breakers have been triggered. Step 4. If a thesis breaker has been triggered, the decision is made for you. You sell. There is no debate. There is no new hope. Your own rational, past self already did the hard work and told you what to do in this exact scenario. You are simply executing the plan. This system bypasses loss aversion, the sunk cost fallacy, and ego. It forces discipline. It also creates an invaluable feedback loop. Over time, you can review your journal and see why your theses were wrong, helping you make better decisions in the future. This journal is the foundation of your personal financial education and the core of your unbreakable portfolio management system. The antithesis of this systematic approach is decision by headline. This is the realm of the pure amateur. This investor has no process, no thesis, and no discipline. Their decisions to buy and sell are driven entirely by external stimuli, a fear-mongering headline on a news website, a hot tip from a TV pundit, or a panicked discussion on a social media forum. When they buy a stock, they have no clear reason, so they have no framework for when to sell. They are constantly whipsawed by market sentiment. When the news is good and the stock is rising, they are euphoric and might even buy more at the top. When the news turns negative and the stock is falling, they panic and sell at the bottom, locking in the worst possible outcome. They are not investing, they are merely reacting. Their portfolio is not a curated collection of businesses, it is a chaotic reflection of the market's daily mood swings. This path is a guaranteed route to underperformance, high anxiety, and eventual financial failure. It is the complete absence of a system, a total surrender to the emotional whims of the crowd. The ultimate financial connection, the reason this entire system works, comes down to one of the most beautiful concepts in finance, the asymmetry of returns. Legendary investors don't make their fortunes by being right all the time. They make their fortunes by structuring their investments so that when they are right, they win big, and when they are wrong, they lose small. This is an asymmetric bet. Heads, I win a lot. Tails, I don't lose much. The entire framework we have discussed today, from instantaneous reevaluation to the systematic investment journal, is designed to create this asymmetry in your own portfolio. The discipline of cutting your losses quickly and ruthlessly, mechanically chops off the potential for catastrophic losses. It says my downside on any single idea is capped at 10% or 20% because my process will force me to sell if my thesis breaks. This act of capping the downside is what gives your winners the room to run. If your losses are small and your wins are big, you can be wrong half the time and still make a tremendous amount of money. A portfolio managed with this discipline has a built-in structural advantage. It is anti-fragile. It learns from its mistakes and gets stronger over time. This is the secret to true, long-term wealth protection and growth. It's how you move beyond simply picking stocks and begin to engineer a financial future that is resilient, rational, and relentlessly geared towards achieving your financial freedom. You have just journeyed through a complete system of thought. This is not just a collection of tips about when to sell a stock. You have installed a new operating system for making financial decisions, one that is built on intellectual honesty and emotional discipline. You now possess the mental tools to separate your ego from your capital, to view your mistakes not as personal failures but as priceless data. This ability to treat every dollar in your portfolio as a forward-looking soldier ready for its best mission is the foundation of all serious wealth. This isn't just an investing tactic, it's a profound upgrade in your mental hardware. But understand this principle of admitting mistakes and cutting losses, as powerful as it is fundamentally a defensive maneuver. It is the unbreakable shield. It is designed for capital preservation, for ensuring you stay in the game. A shield alone, however, does not win the war. Buffett's true genius lies in how he pairs this impenetrable defense with an equally powerful and aggressive offense. Knowing when to sell is half of the equation. The other half, the part that creates the truly exponential growth that has defined his career, is knowing what to buy, and even more importantly, when to concentrate your capital with absolute table-pounding conviction. This entire system of thought is a network of interconnected mental models, and you have just secured a critical, foundational node. The video that YouTube is now recommending on your screen is not an accident. Its algorithm, by analyzing your commitment to mastering this topic, has identified the next logical piece of the map for you. It is the link that connects the shield of capital preservation you have just forged with the spear of offensive capital allocation. It is the bridge from protecting your wealth to aggressively and intelligently compounding it. Many people will stop here. They have learned a valuable lesson, and for them, that is enough. But a select few, the ones who are truly serious about constructing a fortress of financial independence, understand that this is not the end of a video, but a single step on a lifelong journey of mastery. The choice, as always, is yours. Is this the end of a lesson or the beginning of your ascent? If you are ready to complete your mental arsenal, to build not just the shield but the spear as well, the next piece of the puzzle is waiting for you. Click and continue the mission.